If you had two companies that were exactly the same, and one was growing 20% a year and one was growing 5% a year, which one would you pay more money for? So we still have more to go. Apple dominates their market. The question is, what premium do you pay? Apple stock has gone down quite a bit. Apple is the largest market cap company. Now, to us, Apple is the company that has to be. When I see people giving up on Apple, that's when I'll say, okay, we're near a bottom of some sort. This is something I took from a good friend of mine named Michael. He said, Paul, I will think we're near a bottom when people have said Apple is done. That's what happens in every major bull market that falls, whether it's stocks, real estate. You have to have people give up on the investments they said are the tried and true. You stick with these. Back in 2000, it was Microsoft. When Microsoft, everybody said, listen, we get it. All these other companies might be high flyers, but Microsoft is the one. And when people gave up on it, it was down 80%. Now, does that mean Apple's going to fall 80%? No, I'm not saying that. However, Apple is the largest market cap company. They're in the S&P and NASDAQ 100. All the people who've bought all these ETFs, when they buy those ETFs, these ETF companies have to buy every stock within them, and it drives those stock prices up. So what happens when people start selling those ETFs indiscriminately? We still have inflows on ETFs in the last year, even with the market down. That tells me we're not anywhere close to the bottom of this. And when people start selling ETFs indiscriminately because they're just scared of losing all their money, Apple will be hit very hard. Let's check out Apple and its numbers. Now, keep in mind, I believe Warren Buffett, I've said this in many videos, is buying Apple sub 140. So currently, it's at and by the way, it's pure speculation based on timing of things. I don't know the exact number that he wants for Apple. But I do believe sub 140, he likes it. But the stock on January 4th, 2022, a little over a year ago today, was at 182.94, 183. It hit a low recently of 124.17. That's a 33% drop almost. Now, the market's down a lot. Down, S&P was down 20%. The NASDAQ was down over 30%. I don't think we're done. Why is that? Well, my stock market to GDP ratio says we're at 62.9% overvalued based on history. And this is higher than we ever were in the dot-com bubble based on this data. So we still have more to go. Now, what's helping this? Well, GDP is growing like crazy. Why? Because inflation's high. So that GDP number keeps going up and up and up, and that can really help drive this overvaluation down, which is good. That'll help things become more and more reasonably priced. But what's easier? It's easier for stocks to fall. And people are getting a little annoyed with where stocks are going, have been going the last year. I was just at a family get together this weekend, and one of the nieces of my fiance said, man, the stocks are going terrible for me. She talked about some investment she made. Well, it's better than the stock market for me. It's like, oh, okay. Now, she hasn't given up on stocks, but that's where we need to get to. When we give up on stocks and we give up on Apple, that's probably where we're going to go. Now, let's look at the Apple one-year price, down 22.66% in the last 1 year. This year so far, it's up 6.5%. So let's go look at the fundamentals of Apple. They pay $14.8 billion in dividends. They had $111 billion in free cash flow in the last year. Geez, oh, Pete, look at this return on invested capital, 39%. This is what Warren Buffett loves. This is why he's paying a premium to the company, because he loves that high return on invested capital. Now, stable profit margin, but look at these PEs. 21 in the last year, 29 for the last 5 years. I remember a time 5 or 6 years ago, it was 9. And somebody messaged me and said, Paul, I know you're a value guy. Is Apple a value play? I said, listen, if Apple can keep growing its revenue and profit, it's absolutely a value play. That's where I made the mistake. I didn't think they could keep getting bigger and bigger and bigger, and they did. So I didn't buy Apple back then. And that was 5 years ago. Where was it 5 years ago? Holy cow. It was at, what, $43, $45 a share. It is what it is. Now, what's Apple worth today? Well, I don't know. Let's go check it out. Let's look at the 8 pillars first. So we love this on the 8 pillars. We have 6 check marks, and the 2 X's are the 5-year PE and 5-year price to free cash flow. Now remember, just because they have the X's here doesn't mean they're overpriced. If they can grow their revenue profit or have such a high return on invested capital, it can justify a much higher PE or price to free cash flow. If you had 2 companies that were exactly the same, and one was growing 20% a year and one was growing 5% a year, which one would you pay more money for? Of course you'd pay for the 20% growth a year. Of course you would. High return on invested capital means they're getting a good return on the money that's invested in the business. One with a higher return on invested capital is going to get much higher return. They have to spend less money to keep driving up their profit and revenue. That's the key there. Apple has that. So you should pay a premium. The question is, what premium do you pay? I don't know. So let's go to our analyst estimates and see what the analysts think the company is going to make in terms of revenue and profit over the next few years. So they're currently making, in 2023, they're expected to make $6.36 per share. And the analysts believe they're going to make $8.17 in 4 or 5 years. Now, the number of analysts are declining as time goes on. Now, for revenue, not much growth here, guys. So how's Apple going to pay its money? It's going to buy back shares, decrease its invested capital, issue dividends. That's how they're going to drive a lot of profit drive a lot of returns for its investors. It's not going to grow itself because, guys, it already does $400 billion in revenue. $400 billion in revenue it's expected to do this year, $415 billion. How do you make that bigger? Well, as the world gets more and more, we have China, India, Africa that are about half the world's population, maybe a little less. No, actually maybe a little more. And they're still lagging us in technology because it's a more developing economy. But as the world gets larger and larger and gets more economically profitable, more and more people's lifestyles will increase. They'll buy more products. So that's the key here. So let's go to our stock analyzer tool. If you're new to our videos and channels, first off, you need to subscribe because we do these videos every single day. We do 15 to 20 videos a week. We look at individual companies, but we talk about investing and value investing. We look at investment. We look at buying a stock as buying a piece of a business, okay? This software is available at everythingmoney.com. Check it out. We have a great risk-free guarantee right now. If you buy the software within a month, if you don't like it for whatever reason, email us, money back guarantee, all right? Now, there are thousands of people in this community that talk every day about investing. It's a great way to get your mindset the right way. You know, I had somebody recently reach out to me on Instagram and said, Paul, I just don't think it makes sense for me to join the software. I said, why is that? They're like, well, I only have $10,000 in money. If it's $30 a month, that's 3.6%. I said, okay, how important is your thought process? Well, it's very important. Why is that? Well, because I know I'm going to be much wealthier someday. That's why you invest in yourself today. This is investing in yourself because it gets your mindset into the right way of thinking about money. That way, when you do have the tons of money, you're not going into it going, holy crap, what do I do now? No, you sit there and can understand and learn for the right time in the future. The right time for learning is today. Let's look at our revenue growth numbers. Let's make a 10-year, actually, I'm gonna do a 20-year assumption on Apple. I'm gonna do a 20-year analysis on Apple. Now, because I'm going so far out, I wanna make lower assumptions because the ability for them to do 7, 8, 9, 10% growth over the next 20 years is probably not very high. So I'm gonna go with 3.5, 5.5, and 7.5% revenue growth. Now you might be sitting there going like, whoa, 7.5, that's so low. I get it. It might seem low, but it's a $400 billion company. At 7.5% revenue growth for the next 20 years, 1.075 to the 20th power times 400 billion, they'd be doing $1.7 trillion in revenue 20 years from now. Now, that's a lot of money. But if inflation's 10% a year for the next 10 years, that's gonna be easy. But if inflation tames down and the world grows, and then we have a couple of recessions in there, it seems pretty reasonable. So that's where I come up with the 7.5%. Could it be wrong? It could be wrong. Heck, do me a favor. Make this 3.5, 6, and 8.5%. Fine. The point is, it's the highest assumptions, and you got to take it with a grain of salt, but it wants to show you the spectrum of where the company can be worth. Profit margin. Now, as you can tell, profit margin has been getting better. The last 10-year average is 22.8, 23.5 the last 5 years, and 25%. Now, as the company gets bigger and bigger, can they sustain those profit margins? Well, maybe. I don't know. So let's sit there and put in 21 to be conservative, 23, and 25. Free cash flow, a lot more consistent. I'm going to do 23, 24.5, and 26. Now, PE. Guys, it has a high return on invested capital, which justifies a higher PE, but it doesn't have great growth level. But it is a moat. Apple dominates their market. People have been ingrained in Apple. Whenever I want to do something like a home device, I look for Apple first. Why? Because I already have Apple products. So that's the reason why I probably want to pay a better PE. I'm going to go low side, 15, middle, 16.5, high side, 18. I'm going to do the same thing for my price of free cash flow because those tend to be the same. Now, finally, what is my desired return? Well, guys, I can get 9 or 10% by investing in an ETF. This is basically my margin of safety. The higher my return, the more margin of safety I have. So if I can get 9 or 10% from an ETF, I want a higher number. And the higher my assumptions, the less likely they are to happen. Therefore, I need a bigger margin of safety and a larger desired return. Guys, I really encourage you to rewatch this portion of the Stock Analyzer tool. We had over 1.2 million uses of the Stock Analyzer tool in 2022. Actually, it might have hit 1.3 million uses of it. It's our most popular feature. Please make sure you understand it, because when you sign up for the software at $1 a day, you're going to sit there and use this like crazy. Oh, new video just came out. I will watch that later. So, desired return. I'm going to go with 12, 13.5, and 15. Now, one thing I want you guys to remember, and you've seen in this video, I've done random numbers. And if I ask Mo to do it, he'll give me different numbers. If I ask any users, the point is, you want to sit there and look at this and say, is it reasonable? Is it within the realm of possibility? So I hit the Analyze button. Boom. All right, I got a low price of 65 or 70, a high price of 105, middle price of 82 to 88. Now, remember, this is assuming these returns. So if I hit all my high numbers here, if all of these things come true and I pay 105 for the company, I'm going to make a 15% return. So it's not what I think the company is worth. It's what I'm willing to pay based on these margins of safety. And guess what? I have the company on my watch list at 100 because I want to be able to sell puts at lower prices. I'm not going to buy it at 100. But remember, don't take all of these the way I'm doing it as, oh my God, I'm going to buy Apple when it hits this price. No, go do your own research. Learn this process. If you do that, you will be better in investing, because the more you learn, the less you fear. Do not forget to subscribe to the channel. Thank you very much for your time.